What is up, ladies and gentlemen, loan officers and agents, appraisers, titlers, and everyone
Titlers.
who title folks, somebody. Welcome to What the Fed. My name is Sean Grapevine, Vice President of Strategy here at UMortgage. We are here to tell you about where we've been, what happened yesterday, where we're going, all that relates to rates and interest rate markets. I am joined here by the one, the only, a man who needs no introduction, but who, as usual, gets one anyway. Andrew Cady, he is the Seminole man of Florida. I don't know. I just like the Seminoles are in Florida, but Seminole also means like the number one guy of Florida. It's just trying to pun on the go there about Florida. Forget I said anything at all. Andrew Cady leads our epic mortgage team in UMortgage. He is an all-star originator, and he also has all the knowledge, all the insights about the workings of the market and how it affects our day-to-day line of work. So, Andrew, welcome to the show.
Yeah. Thank you so much. I just have to open by saying go Gators because I'm not a Florida State fan. So nonetheless, but we'll just carry on from that one. But yeah,
it was a 50 shot. I could have called you yeah, forget about it. I gotta prepare better next time.
I am the Florida man.
There you go. That Florida man from the headlines. You've read about him in every publication. He is Florida man himself. Anyway, welcome to the call. Excited to dissect what's been going on over the last couple months and weeks with you.
Yeah, 100%. So we had wonderful Jerome Powell, at the press conference yesterday at the microphone. And the guy's just masterful, in my opinion. Like, he is so masterful at not answering questions or skirting around a full answer for a question. It's unbelievable.
So let's set the stage for everybody, and then we'll enrich it with your texture there. Let's talk a little bit about rates last year, and where we kind of ended the year, and how that prepared us for the Fed meeting going into today. I mean, you ran a team all last year. Have you ever seen a rate market that rivals last year at all in terms of chaos and horrible outcomes?
Yeah, I mean, fourth quarter we hit, I believe it was a 22-year high on mortgage rates. Like, the affordability just bottomed out for the housing market, and we saw it, immediately. We saw these 8% interest rates hit in October, and then November, nationally, the mortgage industry production just fell off a map. Like once the 8% psychological barrier kicked in for buyers.
I mean, it's like, what are you going to do? I was like, all right, props. Every time we locked the loan, I was like, all right, props to you, buyer. That's a high, it's a high rate. At some point I was like, it's just high. It's just high rates. But
yeah.
Now the interest rates get higher, mortgage rates get higher as a result of the Fed. I mean, of a lot of things, but the number one mover of that is the Fed raising their core, the overnight federal funds rate, as it's called. And they did that all last year. And that's what led us to those eye-wateringly high rates. That being said, inflation, or at least what the Fed uses to measure inflation, has largely been brought down from the nines, right? Like, it was in the nines year over year earlier last year to somewhere in the high twos or low threes. I mean, did it work? Did it kind of work? Is this a smoke and mirrors, and it didn't work? What do you think?
I mean, I think it worked. I mean, obviously, it's the term is quantitative easing. When they go in and they buy things, well, then they go to quantitative tightening by making money harder to access by raising the federal funds rate. It's essentially market manipulation on a very high level scale. But yes, I mean, it essentially did work. I mean, if you just think about the economics of it, is if they're raising the federal funds rate, then it raises the cost of money. The cost of money goes up. For a business that used to get a 2% interest rate on a business loan, it's now 7% on a business loan. It's going to make money more restrictive, which is going to slow the economy down, which is going to bring costs down. And it did work. We're seeing inflation, on the short term, actually below what the Fed's target should be. which is kind of baffling that we're not in a rate cutting environment at this point. But this yesterday's meeting marked the fourth meeting in a row where the Federal Reserve has paused. So
Mhm.
we've now 4 Federal Reserve meetings where they've said, "Hey, we're not going to do anything. We're not going to raise rates. We're not going to lower rates." So they went through their raising cycle. They raised it higher and faster than anyone has ever raised it in the history of this country.
After lowering it faster than it's ever been lowered and keeping it low for longer than it's ever been kept low.
Correct.
That also correct?
Yeah. Yeah, it is correct. They're basically I like to say that Jerome Powell operates looking out the rearview mirror. Like he's like, let's go 200 mile an hour and let's see the carnage we cause. And it's like, oh, that's too much carnage. Let's slow down. But yeah, it's essentially they're definitely rearview mirror operators.
Interesting. So that being said, there was at the end of last year, the last Fed meeting was when, so just so everybody out there knows, there's two parts of the Fed meeting. There's the part where we all know what's going to happen, which is, a pause, a lowering of the rate or a raising of the rate. And sometimes there's some question about how much they're going to lower it, how much they're going to raise it, depending on like how quickly the Fed feels they need to react to the action in their rearview mirror, and or how much they need to react to it. And so so there's that, like there's the decision itself. So it's always, I mean, the Feds learned their lesson because it used to be they would throw out some surprises and then bond traders and the entire financial markets would just whipsaw. I mean, just absolutely overreact. So now they really telegraph their decisions weeks and months in advance. I mean, they're
Agreed.
talking about like they were talking about the March meeting in December because they don't want to cause any surprises. Now, the thing that traders then look at in their desperation for the crumbs of information that Jerome and his compatriots leave behind is the conference that Jerome Powell himself gives directly after the meeting concludes on Wednesdays, and then the next week or two, the Fed governors and the Fed presidents that are scattered all around the country of unclear, kind of what their job description is, other than to hold the occasional press conference themselves and to say, hey, oh, that's where they really give the color about. That's when they start the telegraphing. We are thinking about lowering in March. We're not thinking about lowering in March. We're thinking about raising in March, that kind of thing. And the market kind of just takes from all of these 10 or 12 key participants and forms a decision or a sort of consensus about what they think is going to happen next. Is
Yeah.
that correct?
Yeah,
All right.
it's correct. And if you look at like the December meeting, or the previous Fed meeting, Jerome Powell came out with a very what we would call a dovish stance. He came out talking about future rate cuts as soon as March, and it had this big flowery message, and that's why we saw mortgage rates come down and come down quickly towards the end of the year. And I believe it was somewhat of a coordinated effort because they saw the runaway train of interest rates hitting 8%. They had to stop that train from running away. So they talked about future rate cuts. They were very, welcoming to the market on it. And then over the course of the next few weeks, the other Fed presidents or Fed chairs came out and had less nice things to say.
Sure.
And they
Which
kind
is
of
which
walked
is a
back.
which is rare. So I think you're onto something because generally Jerome has been the very careful one, and then
Correct.
everybody else has been like, they're just like spouting off in these press. They're like, nah, we're definitely going to raise them, and he's like, oh no.
Yeah,
But
yeah,
he's
yeah.
he's usually very cagey. So December was super interesting when he was like,
Yeah.
yeah, no, we're thinking
The,
about lowering them soon. What?
the December meeting, I think, was very coordinated. They needed to stop the runaway train. The housing market was falling off a cliff. So they came out with that message, walked a lot of it back, but they did it somewhat masterfully because, yes, rates came down, but they didn't shoot right back up. They kind of gradually went up a little bit over time. But then yesterday, they kind of came out with a different stance on it, and it's kind of an interesting world we're living in. So, what's your thoughts on yesterday?
Yeah, okay. This is the real meat of the issue here. And guys, if you have any questions about what we're talking about, feel free to put them in the chat, and I will look at them and relay them to Andrew so that you can get an actual answer. But yeah, my thought was, okay, this seems significantly more conservative than December. Yet, I guess the bond traders didn't really think so because you saw 10-year go down, you saw the price of mortgage-backed securities go up, which means interest rates go down. And Powell even said like, "Hey, we haven't seen sufficient proof that inflation is headed to 2%, which is their target, to plan any rate cuts, especially not as early as March. I mean, that's almost word for word what he said. And traders were
Yeah.
like, "Oh, this is great news," and rates went down anyway. I think there were a couple other non-Fed related factors to that, but it was interesting to see like they got more conservative, but I think people believe the December Jerome more than they believe the January Jerome for some reason.
Yeah, and I think there's good reason for it. And I'm a believer that we would still see a rate cut in March. I look at just the economics of it. The Fed is only going to have 8 meetings this year. They've already had one that they're pausing on. So now we're down to 7 opportunities for them to take action. They're projecting 4 rate cuts this year. So we know that based on their own plan, 4 out of 7. And I think if they're going to find themselves in a situation pretty quickly that if they don't start making action soon, there's going to be a lot of people that really question whether it's market manipulation at a time of election, because we do have an election year coming up towards the end of the year. And so I think we see a small rate cut in March. And I think they're kind of coming at it in a harsh stance, but I almost don't see how they don't do it, because they could pigeonhole themselves if they pause again in March. Then they're only left with 6 meetings before the end of the year, and we could find ourselves having to do significantly bigger rate cuts and really shocking the market rather than beginning the trickle down effect. Now, the only thing that gives me pause to this whole thing is just maybe the Federal Reserve prior to yesterday's meeting had a little bit of insider knowledge of what the jobs report might look like tomorrow.
Mhm.
And if
Well, and
they
we saw today to talk about jobs. So there's really a trifecta of things that we look at for interest rate, right? So we look at what the Fed says. And the Fed looks at the jobs report. They think, hey, if everybody's employed, prices are going to keep going up, so it's going to adversely affect inflation. So job unemployment rate going up is a signal to the Fed that their policies are working. Unfortunately, for people who lose their jobs, I mean, it's kind of a like macabre, thing to engage in. For them to be like, oh yeah, we were successful. Hundreds of thousands of people lost their job. Anyway, it's crazy. So there's unemployment, and then we've also got various measures of inflation, right? The CPI, PCE, things like that. And so the Fed has really been relying on jobs numbers as one of their key indicators for what they're going to do. And we even saw today in the weekly claims that weekly claims were 17,000 higher. It was 224 versus the forecasted 207,000 unemployment claims. And the market was like, okay, I mean, this seems to be working. But to your point, you think the big jobs number, the Bureau of Labor Statistics job number tomorrow, you think it's going to come in low,
I
or
I
unemployment rate's
I
going to come
think
in
I
higher.
I think they have a trick up their sleeve. If we look at last
Wow.
January's job report for 2023,
Hmm.
there was expected to be 214,000 jobs created, and there was 884,000 jobs created. And if you actually broke that report down
Just
and
a
you began
rounding,
to
a rounding error.
well, if you begin to look at that report and you look into it, well, 804,000 of the job creations were actually created through a metric they use called population control, where they take all of the undocumented people that come into the country and obtain employment. And rather than putting them into the jobs report every month, they lump them together through a population control effect for January's report. So in January of last year, it should have been 100 and some thousand miss, but because there was only 80,000 jobs created, but the report headline said 884. And I'm wondering if we see the jobs report again come out tomorrow with a very big gangbuster number, and perhaps the Fed had a little insight into what that might be, and that put them on that kind of tough stance at that meeting yesterday, thinking that the jobs market is staying very, very resilient and they probably don't need to cut in March. But I guess we're going to find out when the jobs report comes out tomorrow.
Yeah, I'm curious now. I'm super curious. I really do think it is like this crazy metric to watch where you like if you want better interest rates, you have to hope people lose their job. It like really like peels back the onion on like this like oh, how crazy the economy is and how it works. But yeah, I mean, we're gonna get this information. The following week we're gonna get CPI again. So that's the inflation measure, which some people have issue with how it's measured.
Yes.
Uh, are you? Do you count yourself among those people?
I most certainly do because it's just simply not realistic. I mean, it's just simply not a realistic number. But let's talk just real quickly on the core inflation because like core inflation, stripping out food and energy, that is what the Fed's metric they watch. That's the number they want to see come down to 2%. And Jerome Powell says yesterday, he says, he doesn't think that it's likely that the committee will reach a level of confidence by March that core inflation is going to be at that 2% anytime soon. But if you actually look at the last 6 months of core inflation, we have an average of 1.85%. So we're actually running below their 2% target. If you go back 8 months, it's at 2.08%. And I think the Fed is playing a very, very dangerous game. This higher for longer, if we actually get to this point, they could undershoot their inflation. If we skip the March meeting and then we skip the May meeting and they continue to play this game, we could actually undershoot inflation and go to a serious deflationary situation in this country. And I'm not sure that they're reading the metrics the way that they're actually should be read. Like, yes, the year over year numbers aren't at 2% yet. But for the last 8 months to be at 2.08%, it just might be time to actually take a step back and start reducing what caused this entire mess.
Yeah, I mean, yeah, deflation is neck and neck with as scary as inflation, and in some senses scarier. So I certainly agree with you there. So all right, so a lot of speculation here, guys. A lot of opinions, but I mean, definitely good uh perspective to get on this because I think it's really like you can read the headline and not really know the like alternate viewpoints because the headlines pretty much across the board all say one thing and it takes a deeper level of reading. So that's why we have these calls. Now I think though that we take a second and talk about like what does this mean for home buyers in 2024? What does this mean for real estate agents and what does it mean for loan officers? I think, it looks like even if the Fed is playing chicken on timeline, there's certainly going to be rate cuts this year. I was assuming like there's not some ridiculously high or surprising CPI, but I mean, I think even CPI has started to pass the smell test, like at the store. I mean, prices are still higher than they were, but like every time I go to the store, prices aren't higher like they were in June
Yeah.
of last year. You know what I mean? Like it's stabilized. Prices seem to be increasing at like a somewhat more measured rate. So yeah, I think there's certainly going to be cuts. It's just a matter of when. Now, what does that mean for your average client? Should they be playing the waiting game? Should they be waiting for cuts? Are these rate reductions priced in enough right now that you can already kind of take advantage of them?
So my opinion is always, and I posted this actually yesterday on my social media. The absolute best time to buy a home is always sometime in the past because we have
Mhm.
rear view is 2020 vision. In my opinion, the second best time to buy a home is right now. Let's not forget that buying a home at today's interest rate, you can always modify the interest rate on your home, but you can't always get the home for the same price next month that you got it for today. And we're already seeing this blow up. Like we're seeing record breaking numbers starting to come in. Like traditionally, January in the mortgage industry is one of the slowest months of the year. It just is. Even in Florida, where we don't get the harsh winters, but January is always a very slow month. We broke all sorts of records in January. And it's what I've been saying now for a year coming into this is don't make a mistake and think that buyers are out of the game. Buyers are on the sideline. Think about it in a football game. Just because they're on the sideline doesn't mean they're off the field. The moment rates come down, buyers are coming back to the market. We already see that we have a significant shortage of housing that is available in our market. We're short, some estimates say, by just about 3 million homes for demand. Now that demand isn't felt right now because the buyers are on the sideline. But if the metrics we're seeing that are being reported, and I would agree 100% that we see interest rates in the mid fives by end of year, I think rate cuts are a foregone conclusion that will happen. And I think rates will come down with it. At rates that are in the mid fives, we're going to have an influx of buyers and we're going to be back to highest and best offers. So my long answer to
Oh,
that summarized is you could buy a $500,000 house today at a 6.75 interest rate or whatever the number might be and refinance that in a year and still get that. You still got the home for 500. But if rates drop to 5.5 tomorrow,
it's
that $500,000 home is going for 550.
easy. Yeah, 100%. I mean, yeah, we're seeing it right now. We, at UMortgage, just for total transparency, we probably added, I don't know, 10, 20, 30 loan officers in December. But, our lock volume, which is like how we measure how many loans we've locked in a certain month, is up 40% in January over December. Now, I mean, that's like crazy. And a lot of it's because, we've been improving our loan officers. Our marketing's awesome. We've added some loan officers, all that stuff. But like a 40% month over month change is usually like you can smell the macroeconomic trend on that. That's because buyers themselves have convinced themselves that it's time to buy. And that's what the reduction of, like you said, rates in like the low eights to, early January or all of January, rates in the high sixes, low sevens, rates that would have, been heretofore unthinkable even just a year ago. Like people are like, wow, this is actually palatable. And so when you see those in the fives, I mean, but before COVID, 2019 was my best year in the industry ever. And, rates were relatively normal during like the 10 years prior to that. And 2019 was the first time I really saw rates in like the high fours and low fives. And you know what? The Atlanta real estate market was humming. Like I couldn't pick up the phone fast enough. Like people were doing tons of business. So I think the American public has shown like that high fours to high fives is, I mean, that's totally palatable. I mean, they will happily buy a house at those rates.
And I think there's a big psychological barrier for sellers. 68% of all mortgages, I think those the number. 68% have an interest rate below 4%,
Mm,
and that's a lot
tough.
of mortgages.
Mhm.
And if you're selling a home and you have call it a 3.75 rate on that, going to a 7 or an 8% rate that's a big
It's
monthly
tough.
payment change. However, I think that needle moves when that interest rate begins to get down into a 5. If that front handle on the interest rate is at a 5 and you've got say a 4% and now you're going to 5.75 on it, it's a much more palatable move. And I do think we're going to see real estate as a whole begin to free up probably third, fourth quarter of this year, where we actually start to see sellers openly selling again and buyers. I think for me, I've always considered a healthy real estate market is interest rates in between 4.5 and 5.5. Like what we
Yeah,
went through in
100%.
2020, 2021 is
Not
not a
healthy.
healthy
Fun.
market.
Fun.
It was fun. It was wild. And I'm happy I locked in one of those rates on my primary
Oh yeah,
residence. And
100%. Well, I know, and I'm like, gosh, I wish people would just sell their houses and get over it. And I'm like, you know what? I would never sell this house with the interest rate I have on it until rates come down. So I totally get the reticence. So we got about 5 minutes left, and would love to take any questions from the crowd. Our amazing video team will just plant them right here on the screen for us. Yolanda asks, what's the current rate? Well, that's a wide ranging question. So the current federal funds rate, just to be super clear, is
five
well,
and
of
a
course
quarter
they
to
give
5.5.
they give a range. So 5.25 to 5.5. What that means for mortgage interest rates, which run about 2 points to 3 points higher than that, is rates are in the you know high sixes, low sevens. It's really hard to say. That's for a conventional loan, depending on credit, depending on size, depending on the area of the country, depending on all sorts of things. But that is like what I would say if somebody were to ask me. And then government loan rates, FHA, VA. I don't know. You probably quote those more often than I do. But
I
like
mean,
I don't know, high fives.
looking at like Mortgage Daily News, that they
Uh-huh.
publish the median rate given out, and I think that's a great way to look at it because there's so many factors that go into rate. What's your down payment? Is it a primary residence? Is it a second home, investment property? Where's your credit score at? There's so many factors that go in. Mortgage Daily News puts out the publication of just the median interest rate given out at the current time across all the credit scores, everything. They're putting right now the 30-year fixed conventional at a 6.63, FHA at 6%, VA at 6.04%, 15 years about 5.95%, And that's just a median of what's being given out.
Yeah,
Some are going to be higher.
that's not the U mortgage, just like absolute low margins, high quality, amazing loan officers, will price match guarantee-ish, show us your best offer. We'll do our best to beat it. So it's whatever you see there, just assume that we're gonna crush it. But that is
Always.
the actual average. Caden asks, how does the Fed's economic outlook align with or differ from current real estate market trends? Yeah, I think Andrew really answered that like the problem with none like rates going down is that none of this exists in a vacuum. When rates go down, real estate prices go up because real estate gets cheaper, more people in turn to the market. And to Andrew's point, people now those reticent sellers have also thrown their hat into the ring, and they're willing to upgrade when rates are 5.5 instead of 7.5. Would you say
I
that? Like, go ahead.
Yeah, I think along these lines, not necessarily the real estate trends, but I think what's really interesting is the Fed's outlook versus the market's outlook. Is the Fed is planning 4 small rate cuts this year, but the market is looking at it and they're like, oh no, we're gonna price in that you guys are gonna do the equivalent of 7 or 8 rate cuts this year. And so I would tend to believe what the market believes a lot more than what I would believe what the Fed thinks, because they have not proved themselves with a great history. As my favorite meme in the world says, if you can't convince them, you confuse them. That is Fed Chair Powell in a nutshell. That's just how it works.
And you guys can look at what the market thinks as compared to what the Fed says or what they telegraph. There's a chart on the CME Group website. If you just search CME Fed Funds predictions chart, something like that, I'm sure Google will get it to you, and you can see with anything in this fine country of ours, if you can bet on it, you can make money on it. And so there's a whole side of the market that is based on betting what the Fed funds rate will be at a certain time. It's pretty bonkers. And if you look at the March meeting, 38% of people, or traders, I guess 38% of traders think there's going to be a reduction in interest rate, and 61.5 think that there isn't. And then like 0.3% of people think it's going to be a double reduction in rate, but those people are out of their minds. And then you go all the way out to the December meeting, and the consensus, the one with the most, 43.9% of people think that we'll be all the way down to 3.75 to 4% on the Fed funds rate, which would imply 6 or 7
Rate cuts.
reductions which is a lot. And to your point, Andrew, there's not a lot of meetings left to do that if you do it slowly. I mean, that would imply, if we're skipping March, you would have to have one at every meeting, or if you skipped another one, you would have to have one with a double dip. And those proof, like, usually the Fed reserves those for pretty like incendiary time. So I'm kind of with you. It's interesting to see them telegraphing no March when the whole rest of the world disagrees with them about what they're going to do.
I agree 100%. So at the end of the day, it's a great time to buy real estate. It's a great opportunity. QE.
Yeah. Another Cady.
One question, Thomas.
Who's let this guy in? You want to take this one?
Yeah. So QE was a huge factor in rates dropping. I'll explain just real briefly. QE is called quantitative easing. It's when the Federal Reserve steps in. I'll call it manipulating the market, and they basically will buy mortgage-backed securities and treasuries. And they did that in March of 2020. They began March 20th, and in a 60-day window, they spent $2 trillion with a T, not billion, $1 trillion on mortgage-backed securities and treasuries, single largest QE in a 60-day window in our history. And that's why mortgage rates dropped as low as they did. The mortgage rates in this country should have never dropped below 4%, but it were artificially held low, and it's created this whole issue we have now is thanks to our Fed. But quantitative tightening is still something out there. The Fed has now built up a balance sheet that's somewhere near $8 trillion that they have to pay interest on. So they're slowly rolling that balance sheet off. Rolling off is not the same as selling. They just fail to renew the bonds that sell out. And so there's a roll-off that's happening, and it's a big roll-off, but that is putting pressure on interest rates up, on mortgage rates up as mortgage-backed securities get sold off. I don't think the Fed goes to outright selling. I think it would spell big disaster. I think as they lower their federal funds rate, that will lower their interest cost on their balance sheet at the same time. And I think you'll have that natural expiration of bonds that will fall off faster. If the Fed would decide to actually go to full quantitative tightening and sell their balance sheet off, there wouldn't necessarily be buyers for it. And it would, I don't want to sound doomsday, but it would literally shut down the housing market. And the housing market accounts for such a large portion of our GDP that they can't do that. Like they simply
Right.
can't shut
Well,
housing
and
down because of how much it plays in the gross domestic product of the United States.
if they didn't do it when CPI was at 9%, then they're certainly not going to do it when they're at the finish line.
I would agree.
So, all right. Well, great questions, everybody. If you have any additional questions, feel free to reach out to myself or Andrew via social. If you're in Florida, shameless plug for the Epic Mortgage team. I mean, honestly, if you're you guys are licensed all over the Southeast, right?
Yeah, we're all over the Southeast.
Hey, if you have real estate needs in the Southeast, definitely hit up Andrew and his team. I mean, they're amazing. They operate at the highest levels, and they obviously have incredible insight into what's going on, what's happened, and what's going to happen. So, Andrew, thank you so much for being on. Watchers, thank you so much for watching. Let us know if you have any questions or anything else you want us to address on the next What the Fed. Thanks, buddy.
See ya.